there. We've established that an investment in shares can be measured either at fair value through profit or loss or at fair value through other comprehensive income. Now, let's take a look at how this is done by way of an example. Let us assume that on the 1st of January 20X7, Company A purchased a 10% investment in the shares of Company B for 1,000 currency units, and they also paid for transaction costs of 50 currency units. The fair value of the investment at the end of the year was 1,400 currency units. Now, what journal entries would you record for the investment in that 20X7 year? Well, the first journal entry would be to recognize the asset at fair value. So at initial recognition, we would need to debit the financial asset and to credit bank of 1,000 currency units. But now, what about the transaction costs? How would we recognize these? If you remember, at initial recognition, all financial assets must be measured at fair value plus transaction costs, unless they are measured at fair value through profit or loss. Because the default way to measure an investment in shares is at fair value through profit or loss, transaction costs here will not be recognized as part of the asset, but will be instead expensed. The journal entry, therefore, is to debit some sort of transaction cost expense and to credit bank with 50 currency units. Finally, because the investment is measured subsequently at fair value through profit or loss, we must measure the asset at year end to its fair value. But in order to do this, we need to determine two amounts at year end, the carrying amount and the fair value. The carrying amount is the 1,000 currency units and the fair value is the 1,400 currency units. This means that there has been a fair value gain at year end of 400 currency units. And in our journal entries, we would therefore just say debit financial asset and credit this fair value gain of 400 currency units. Fantastic. But now, what if the entity had made that irrevocable election at initial recognition to measure the investment in shares at fair value through other comprehensive income? In this case, you would still recognize the asset at fair value initially, but then you would need to recognize the transaction costs as part of the initial recognition of the asset, as the asset is now no longer measured through profit or loss. Your journal entry for the transaction costs would be to debit that financial asset and to credit the bank of 50 currency units. The carrying amount at year end is now 1,050 currency units. The fair value is 1,400 currency units. And so there has been a fair value gain which will be recognized through other comprehensive income of 350 currency units. Take a look at how this adjustment flows through the financial statements. In the section on other comprehensive income, the fair value adjustment must be presented under the category of gains that will not be reclassified to profit or loss. From here, it then flows into the statement of changes in equity, and finally, it is presented as part of the equity in the statement of financial position.